Yeah.
Yeah.
Awesome. Thank you for joining us for How Tax Works. This is the 2025 edition. So, generally, every year I'll do a little tax webinar that outlines how tax works for you. And as usual, every year gets a little bit better. So, this year we're talking about how tax works, how it's calculated, and what sort of things that you need to be aware of when it comes to doing your tax return every year. So, what are we going to cover tonight? So, we're going to look at how income tax is calculated, what you can do to make an impact, and how to pay less tax, and maybe receive more refunds. Um, General disclaimer, all information in this webinar is general advice, and if you do have further questions, please talk to your accountant or any of our accountants at Northwest Accountancy to help you see if they will work for you. Okie dokie, let's jump in. Who am I? Why am I here? And have I got the ability to teach you this stuff about tax? Well, I call myself the chief educator at Northwest Accountancy. I love presenting. I love being able to give the people the knowledge that I've got in my head. I have been an owner of Northwest Accountancy since 2003. Yes, you can do the maths on that and figure out how old I am. And I have been a tax agent and a CPA for more than 20 years. My superpower is to cut out the jargon and easily explain tax so that you can think differently about your finances and not just hate tax or think that tax is a way that you can get some free money. Maybe it is, but there's more to it than that. In 2021, I quit doing tax returns. So from the year 2000 until 2021, I did tax returns all tax season in, out, loved having the conversations with the clients, but didn't really love doing the data entry work. So what I did was stepped out of doing the day-to-day tax returns and stepped into a training role, not just for individuals, but for businesses as well. And so here I am teaching income tax for this year. So, one of the focuses we have at Northwest Accountancy is timely taxes. And what this means to us is that we want you to lodge your taxes on time. We help do that. We want to minimize your taxes because we are allowed to minimize the amount of tax that we pay. Not avoid it, but we can minimize it and prepare early if you're getting any tax bills. So we hate surprises. So we want you to be upfront and able to know what's going on with your tax return well in advance of the day that it needs to be lodged. So let's jump straight in and figure out how is tax calculated. Got to click on the right button. So tax is calculated as you pay tax on taxable income. So where I've got the big bold taxable income, this is the first concept that we'll be running through. So what is taxable income? So taxable income is your total income less your tax deductions, and that's what taxable income is. However, we don't necessarily pay tax on all of our income. So we've got to figure out what is our income amount. So, bam, I'm going to throw you a whole load of incomes. So we've got income from work and dividends and reimbursements and Centrelink and back pay and sale of shares and pensions and business income, all sorts of things that might be money coming into your bank account, but they're not all taxed the same if they're taxed at all. So some things are private that aren't taxed. Some things will be taxed under different tax rules, so capital gains tax, and some things aren't taxed at all. Some things are just taxed as normal income. So let's have a quick little look at this one. So all the ones with the red X's are generally not taxable at all. So if you're getting a refund from somebody, you bought something, you paid for it, and then you've given it back and they've given you a refund. So generally that's money coming into your bank account. You generally won't pay tax on that. It's just money. Same with selling household items down here. So sell your couch, generally won't pay tax on that unless that couch is being used in your business. Reimbursements. So somebody's paid you back because you've paid for something. So, for example, I paid for a family holiday and had several different people put money in my bank account to pay me back for that family holiday. It's just a reimbursement of a private expense, so no tax to pay. And then inheritances, generally, no taxes paid on those, generally. There's always exceptions to the rule with tax. Then we've got our capital gains tax, so our sale of shares and our sale of property. Yes, you will pay tax on them, maybe, but they fall under capital gains tax rules. And so there's different rules to normal taxable income and different things that we have to add and subtract potentially. And then the green ones, love the green ones, it depends. So Centrelink payments, some of your Centrelink payments you will pay tax on, some of them you don't. Fringe benefits tax may impact, or fringe benefits may impact the amount of tax that you pay, and some of them don't. And superannuation, if you receive that as money coming in, it depends whether it's your pension or if it's a lump sum payment or all sorts of different rules as to whether that's taxed or not taxed. So those ones, those green ones, it depends. Most of the other ones, though, the yellow ones, the work, the rental income, foreign income, bonuses, back pay, pension, dividends, web-based sales, business income, they're generally forming part of your taxable income. Okie dokie. So that's the income side of things. Not all income is the same. Not all income is taxable income. But how do we calculate tax? So we've talked about income. Then we need to look at our tax deductions. So what are tax deductions? Tax deductions are also known as claims. Can I claim this on my tax? Is what we hear quite a lot. A tax deduction is something that you've paid for that can reduce the amount of income that you pay or pay tax on. So what are some of these categories? So we've got our work-related costs, which I'll go into further. We've got donations to charities, rental-related costs. So if you've got an investment property and you're receiving rent, any costs associated with that rent or that property are tax deductible. We've got our capital gains for those sale of properties, sale of shares. We've got keeping tax records organised. That can be a tax claim as well, or a tax deduction. If you're running a business, any of those business costs can go against that business income. Income protection insurance. So if you pay for an income protection insurance policy, then that would be claimable as well. If you've got any investments, any claims for those, super that you pay for yourself. So this one is if you've put your own money in, so not work as putting money in for super, you can lodge a notice of intent to claim that super and put a tax deduction in for it. And then, of course, your tax agent fees as well. Let's have a closer look at a couple of these. So our general rules for tax deductions. Number one, it links to your income. So when it comes to your tax deductions, if there's no clear link between what you're spending the money on and your income coming in, then there's generally no nexus of claim. The second one is how your spending leads to more income or to keeping your job. So when you've got that link for your income or link to your current job, you've got an opportunity to go, yes, I'm spending this money so that I can do my job properly, or I'm spending this money so that I can get a promotion in my job. And so that's more for training and things like that. But there's that link between how you spend the money and your current work opportunities. Now, a warning, you can't spend the money before the income. So if you were studying as a nurse, but working as an accountant, then the study or the costs incurred in studying as a nurse don't relate to your job, and we won't be able to claim those until you actually go and get a job as a nurse. So there's got to be that spending after you've got that income not before you've got the income. So another example, do a security course to be a security officer, can't claim it until you've actually become a security officer. Most important things to note, you need to keep your receipts and keep your proof of payment. So you can't claim a tax deduction for anything you don't pay for. Super important. So if work pays for something, or if you've paid for something and work gives you that money back, then you can't claim a tax deduction for it. So it's got to be something you're out of pocket for yourself. Let's dig a little bit deeper into work-related expenses. So here's some of the things that our clients claim. So vehicle costs. So one of the things with vehicle costs is that you can't claim work to home travel or home to work travel. Couple of exceptions to the rule, but generally driving to and from work, not tax deductible. But if you've got your car at work and you go and do errands or go from workplace to workplace or site to site, then that is absolutely claimable, and you can keep a logbook that tells us how many kilometers you do. And if you do more than 5,000 kilometers, we do recommend keeping all of your costs for that car as well, so that you can claim a percentage of that based on what your logbook says. The next one is telephone. So always, and I'll go through this one again, always work versus private. We can claim your work-related phone costs, but we cannot claim your private-related phone costs. So if you've got two phones, one work, one business, one work, one private, then the work phone absolutely claimable. But only if you don't use it for private. But if you've got one phone and you're using it for work and for private, then you may need to apportion it and claim just a percentage of those costs. One thing to note, and I'll get to the work from home at the bottom as well, is if you are claiming a work from home deduction, you cannot also claim a phone deduction as well. So we've got to choose between the two. Choose work from home or choose phone. So that's a tricky one that they've made changes on recently. Tools. So if you're buying tools for use at work, then you can definitely claim those. Laundry, clothing, and boots. Now with clothing, it's anything that's protective. So if you've got a pair of overalls or a hard hat, that's absolutely protective clothing and that can be claimed. But it can also be industry related clothing as well. So if you picture a chef, for example, you can generally figure out what clothing a chef would wear with the white button-up thing and the checkered pants, and that would be an amount of clothing that would be tax deductible because it's something industry specific. If you had to pay for that yourself, then that would be claimable. But if you work for Jeans West and you have to buy the Jeans West clothing to work in that shop, then it's not easily identifiable, and so therefore it can't be claimed. So even if work makes you pay for it, then it's not claimable because it's not easily identifiable for your occupation. So that's clothing, and then of course protective clothing, boots, those sorts of things as well. We can also claim or have a tax deduction for memberships and subscriptions. So anything that you're paying for on a regular basis that's to do with your work, can be claimable as well. So yet again, you've got to have that nexus. So I'm not saying all subscriptions. Your Netflix is generally not going to be tax deductible, unless, I don't know, you're a TV reviewer. There's got to be that nexus or that link between what your work is and what that expense is to be able to claim it. Licenses. So I've specifically put not car licenses in here because everybody's got a car license and it's not necessary for your job. It may be necessary for your job to drive a car, but everybody's got it. Same as reading glasses. Can't claim those either, sorry. But licenses definitely that you can claim. Forklift license. Not everybody's got a forklift license. So if you have that for your job, then you can claim that. And the same for plumbing licenses and electrical licenses and all of those sorts of things as well. So generally trade licenses. Union fees, if you're a member of the union, they will help you and support you with your job if something goes on. So those are tax deductible as well. Self-education costs like courses, books, uni fees, anything that you're spending in order to further yourself for promotion or to make your job a better job, but has to be in the same field, remember. They're all important as well. And then, like I mentioned at phone, working from home. So working from home rules changed a couple of years ago. We can't claim phone and internet and working from home cents per hour. So have a look into that one. If you do any work from home, we do want a log book of all of your hours that you work, not just a guess. So lots of different rules changed for that working from home one. Okie dokie. Let's have a look at your occupation specific guides to work. So if you jump into the ATO website and go to ato.gov.au, which is the website, and do a search for the QC, quick code 72193, then this will give you access to all of the different occupation codes that the tax office has published little sheets for. And I think they're great because they've got little pictures on them and they tell you the little stories about what you can and can't claim. And there's all sorts of different occupations there, from engineer to call center operator, bus drivers, building and construction employees, miners, teachers, and even adult industry workers. So lots and lots of different occupation codes that can help you work out what you can and can't claim before you even talk to your accountant. I love that you can claim these, but even better are that you can't claim these. So these are some of the things over my 20 plus years of doing tax that people have tried me on. So life insurance, no. So income protection insurance, yes, because when you get an income protection insurance claim, so you get money from your income protection insurance, you pay tax on that. But life insurance, we don't want to pay tax on your life insurance payout, so we can't claim it as a tax deduction. We won't pay it when it comes in as income. Dogs and pets, always my favorite. Can I claim my guard dog? Your guard dog, the fluffy little dog that's sitting on your lap and having cuddles? No, no, you cannot. So no dogs, no pets, even though they might be your fur children. Sorry, we can't claim them. GoFundMe donations. So this one's really interesting. I have a lot of conversations all of the time. Your donations need to be to a a deductible gift recipient, so a DGR, and you need to have a receipt that says this donation is tax deductible. So GoFundMe generally aren't for deductible gift recipients. They're generally some mates wanting to help a brother out, sort of thing. So generally, those GoFundMe's won't be tax deductible. Raffle tickets where you can win a house. So same with the life insurance. You don't want to pay tax when you win the house, so therefore the raffle ticket won't be tax deductible. So with donations, you're giving money with no expectation of return. With raffle tickets, you're paying $100 or $50 for a raffle ticket in the hope that you return and get that house. So we can't claim the raffle ticket. We don't want to pay tax on the actual receipt of the house. So in Australia, we don't pay tax on lottery winnings. So we can't claim the lotto purchase or the raffle ticket purchase. Random receipts that say tax invoice. My favorite. We had a beautiful young adult come in with his shoebox several years ago. It was beautiful. Chockers full of receipts. And we pulled them all out, and there was lots of Macca's receipts and KFC receipts and a few Kmart receipts and things like that. And we're like, why did you keep all of these? And he said, they've got tax invoice written on them. So I thought I could claim them. We said, that's great, buddy, but they're not claimable on your tax unless there's a link for your work. So it has to be a link to your work to be able to claim it. It's not necessarily everything that says tax invoice. And then the ATO said no on this one. So coat hangers for hanging your uniform. So we got audited by the tax office. Well, we didn't. My client got audited because somebody else did their tax return. And yeah, no, you can't claim your coat hangers. I love that one. It's great. And then bottom line, anything that's private use, you can't claim. So if it's for your work, yes, there's generally that nexus, that link between work and the tax deduction. But if it's private, sorry, nope, can't claim it. Okie dokie, let's take a breath. Oh, and Joseph's just messaged, water bottles are never deductible either. Mm-hmm. Mm-hmm. Recap. How is tax calculated? So, income tax is calculated on your taxable income. So, we've talked about income and how some things are taxable income, some things not. We've talked about all your tax deductions. So, our income less our tax deductions equals our taxable income. So, now that we've got that figure for taxable income, then we've got a little example for you. So hopefully you can see this. So your wages plus your interest on your bank account gives you your income. And then we take off your tax deductions. So in this example, we've got tools, tax preparation fees from last year, union fees, telephone. So 40% of work was tax deductible. So all up tax deductions, 2,481 gives us a nice round figure of taxable income, 120,000. There's a reason for that. It's easier for the maths. For example purposes only. Generally, you won't see taxable income with nice round numbers like this. So this is what you pay tax on, is this 120,000 of taxable income. So even though work's given you a group certificate or an income statement these days with income of 122,000, we take off your tax deductions, we add on any other income, and so this is what you get taxed on. So what's the next step? So step number 3 is figuring out what your tax rate is. So your taxable income times your tax rate equals the tax that you need to pay. So here we've got the individual tax rates, and this is the 25-26 year, so the current tax year that we're in. But when we lodge our tax return for this year, we're looking at the 24-25 tax rate. So that's what the example is on the next page. But I just wanted to run through what this is and what it looks like. So this is our what we call tax brackets. And what we've got is each bracket of $0 to $18,000 or $18,200. You don't pay tax on that bracket of income. But if you earn between 18,201 and 45,000, you pay tax at 16 cents in the dollar or 16% of everything over 18,200. And then same with 45 to 135, you'll pay 4,288, which is the tax on 45,000, and then add 30 cents in every dollar, which is the same as 30% for everything over 45,000. And then it goes up 37 cents, 45 cents. Now, one thing to note is these numbers here don't include the Medicare levy, so we've got to add another 2%. So when your accountant says you're paying top tax at 47%, we're including the Medicare levy in this 45 cents or 45% bracket. Let's do a little tax calculation. So if your taxable income is 120,000, nice easy maths from the previous yellow example, we're looking at income in this tax bracket of between 45 and 135. So up to 45,000 is 4,288 tax. So this is this much here. And then we add on 30% or 30 cents for every dollar above the 45,000, so another 75,000. So 45,000 plus 75,000 equals 120,000. And so the tax on the 75,000 is 22.5. So those two added together is the amount of tax that you pay for that $120,000. Plus the Medicare levy. So plus the extra 2%, so another 2,400. So total amount of tax you need to pay, 29,188. So that's the amount of tax you pay, including the Medicare levy, for tax on 120,000. So what we do then is we compare this amount of tax to what work's already paid for you, and this determines your refund. So our tax payable minus our tax already paid is what we're going to pay tax on. Oops. So where have you already paid tax? So we've already paid tax on our wages. So our pay-as-you-go withholding, PAYGW, is what most people will pay the majority of their tax. You might also have franking credits if you've had dividends paid to you. You might also have pay-as-you-go installments if you've paid tax in advance of next year's tax return. And this is what you'll pay if you have an activity statement or a pay-as-you-go statement from the ATO. And so they'll ask you if you had a tax bill last year to pay some of that tax in advance for next year. And then if you've got foreign income, you may be lucky enough to have foreign tax credits as well, but generally unlikely for most of our clients. So where do you find your PAYG withholding amount? This is a sample payslip and you'll see it under the tax section. So it's the tax section, in this example, $492, and you'll see that on your payslip. And then at the end of the year when work does the STP finalisation, this amount is lodged with the tax office to say this is the total amount of tax that you've paid throughout the whole year. So let's have a quick look at this. Step 4, tax payable minus your tax already paid is how much your refund's going to be. Or a bill if you've not paid enough tax. So if work hasn't paid enough tax based on what your tax total is, then there may be a tax bill to pay. However, there's one more step that we need to look at, and this is your offsets. So not everybody is entitled to offsets, but there's some people entitled to offsets depending on your special criteria. So offsets generally reduce your tax without having to buy anything. And so they cover things like zone offset, spouse superannuation contributions, foreign tax offsets, carers offsets, defence force members, and pensioner offsets. And generally, if you fall into any of those categories, it's a small amount that will be offsetting your tax that you don't need to pay extra tax for, and you'll generally get a bit more of a refund back. So, deep breath again. Recap. Income tax is your taxable income times the tax rate that you pay, which is the tax you need to pay, less the taxes you've already paid, less your tax offsets, and this gives you your total refund or the total amount of tax you need to pay at the end. So when you process your tax return or when you lodge your tax return, it's an overview of the whole year. Has your income been more or less than what was expected? Have you paid enough tax or not enough tax? And so the lodgement of your tax return is just that adjustment of have you paid enough tax or not enough tax throughout the year? And that's what your tax return is doing. If you've got a refund, it means you've paid too much tax throughout the year. If you've got a bill, you haven't paid enough tax throughout the year. And it's not anything personal. If you get a tax bill, it just means that you've had more cash throughout the year than what you've paid tax. Okay, so if you've gotten to this point and gone, oh, this is a lot of work, I'm ready to leave it to the experts, then I've got a QR code for you so you can jump straight into the Northwest Accountancy page, northwestaccountancy.com.au/tax. And this is where you can either organise an appointment to do your tax with us or drop off your tax return with us, and we'll send you a form to fill out to collect all of the information to do your tax. You don't need to be there. We can just do it without you. So if you're happy to outsource, then go for it. If you want to stick around for the rest of the workshop or the webinar, we've got information about other taxes and how you can potentially reduce your tax and maybe get more refund. But absolutely, you can help. We can help you get your tax done if you're sitting here going, oh my gosh, this is way too much. Okie dokie, what else impacts your tax? So we talked about the Medicare levy just by saying 2%. So 2% of your taxable income is your Medicare levy, and this is money that goes to help fund the public health system, so hospitals, medication, free or subsidized treatment. So really good for us to put 2% of our income into the Medicare system. And work will generally pay the right amount of tax to cover your Medicare levy. And some low income earners will not have to pay Medicare levy. So if you earn less than $26,000, then that's not included in your tax calculations. But the one that freaks a lot of people out or catches a lot of people out is the Medicare levy surcharge. So we've got the Medicare levy, which is 2% that nearly everybody has to pay. And then we've got the Medicare surcharge. Now, the Medicare surcharge is a penalty where you don't have private hospital cover. So it's based on your income levels as an individual or a family. It's based on whether you have private hospital cover or not. And it also depends on the tier that you've chosen with your health fund as well. So all of those three contributing factors, your income, your private hospital cover, and the tier, can impact how much tax you need to pay extra or how much refund extra you get when it comes to lodging your tax return. So this little table here, we've got the base tier, so you don't pay any surcharge at all if you earn less than 97,000 or less than 194,000. If you earn in tier 1, you're paying 1% of your surcharge if you don't have private hospital cover, and it just goes up and up. So $150,000 as a single person, or 300,000 or 302,000 as a combined income, you're paying another 1.5% of your income as Medicare surcharge if you don't have private hospital cover or if you don't have the correct coverage. So a couple of things to note with this. If you've got more than 2 dependent children, then those numbers go up. Those singles and couple numbers go up. If you have essentials cover, so you're paying ambulance cover, for example, or for dental and physio, but you're not paying for hospital cover, then this is not sufficient enough to cover or to get out of the Medicare surcharge. So it actually has to have hospital cover. And if you have hospital cover, but you tell Medicare or you tell your hospital cover that you're in tier 1, but you're actually in tier 3, then they won't charge enough. And so there'll be an adjustment to pay. Or if you tell them you're in tier 3, but you're actually in tier 1, then you'll potentially get a bit more of a refund back. So telling your private hospital cover which tier you're in will impact your tax return as well. My favorite question, how do we pay less tax? Let's have a look. So the first one is negative gearing with properties or shares are generally the two most popular ones. Salary packaging, so giving up some cash for access to something else, for example, car or expenses paid. And then earning less money, my favorite. You pay less tax if you earn less money. It's true. So let's talk about negative gearing for a moment. So the first one is an example of a rental property. So this rental property will actually go into your tax return on top of all of the other things that you've got. So if you've already got that $120,000 taxable income, then your property will add the rent, will take off the rental related expenses. And this will, in this situation, our expenses are way more than what our income is. And so we'll have a negatively geared amount. So this will reduce our taxable income from 120,000 back to 113. And then we'll generally get a refund back of $2,070. Ignoring the Medicare surcharge stuff and offset stuff. So just looking at that 30% deduction. So when it comes to negative gearing, your income is less than your expenses. So this means you've spent more than what the rent is that's come in. Doesn't sound great to me. Negative gearing reduces your taxable income, and you've generally paid too much tax because work doesn't know about your negative gearing. And so you'll get a refund back for the extra tax that you've paid. Now, a lot of people hold on to their negatively geared property going, it's giving me a refund. but assets that don't increase in value and are negatively geared are not building you wealth. So just be careful of that one. Not allowed to give you financial advice, but I am allowed to point out the issues that you may have with your property portfolio. So if it's not going up in value, be careful. The second way that you can reduce the amount of tax that you're paying is salary packaging. So, salary packaging, the very general way of explaining this is that you're giving up cash to access for something else. So it does need to be documented properly. It does need to be signed before payday. You do need to have an agreement in place with your work. Some effective salary packaging options include superannuation. So most employers will allow you to put extra money into superannuation because it doesn't cost them anything, and generally payroll's set up for that. So it's giving up money today to put into your super to access at a later page. Cars. So just be careful with fringe benefits tax implications. Some employers will ask you to pay a tax contribution to pay for the tax so that they don't have to pay for the tax. So be careful on that one. If you're in a remote area, then housing may be eligible for salary packaging, and technology. So if you want a computer upgrade or a phone upgrade, or even most tech actually upgrade, then this can be salary packaged as well. So what this means is we're taking it out as a tax deduction, and work is paying less tax, and you're paying less tax overall. And some of these things can be private as salary packaged, where you can't claim them as a tax deduction in your personal tax return, but you may be able to do a deal with work. So there are some interesting options. And like I said, talk to your accountant, talk to payroll, see if they apply to you. Don't just go in because you've seen it on this webinar. So let's have a look at an example of a salary packaging client. So no salary packaging, they're paying $120,000, or that's their salary. Taxable income is the same. Tax on taxable income, $29,000 plus that proxy Medicare levy. So total tax all up, $31,000. So in their hand, every month when they get a monthly pay, $7,344. Now, if you're putting $15,000 a year into superannuation, then those numbers will change. So our taxable income is reduced, tax on our taxable income is reduced, Medicare levy is reduced, total tax overall is reduced. Yes, we get a net in the hand pay monthly is reduced, but we're missing out on $819 in our hand, but we're adding super of $1,250. So we're adding more super than what we're missing out on because of that reduction in tax overall. So really interesting to do the numbers to see if you're willing to give up $819 per month to put in $1,250 into super. And of course, this is just one example. Your numbers could be totally different. So the magic is in the pre-tax or the before tax deduction. So working out up here whether you want to pay tax or not. Doesn't necessarily give you a bigger refund though, because work will pay the right amount of tax for you. So when you go to lodge your tax return, you'll still only have a similar small refund. So it won't give you a big refund, but it does reduce your tax overall. So nearly $5,000 worth of tax saved for this example. My final example, how to pay less tax, earn less money. So if you earn less money, yes, it will reduce the amount of tax you pay, because on the flip side, the more income you earn, the more tax you pay. Funnily enough, the less you earn, the less you pay. So how can you reduce the bills that you need to pay so that you can work less? So how can you restructure your life so that you can work part-time, pay less tax? How can you pay out your mortgage so you don't need to earn so much? How can you timeshare with your partner so that you both earn less than one full-time worker? And so this is one of the things that some of the political parties like to talk about. A family earning $150,000 versus two individuals paying $75,000 each. Generally, the couple will get more disposable income, more cash in the hand after taxes, than the one person earning the same amount. So how do you balance that out so that there's two people earning less than one person earning more? So interesting option. How can you set up a business and work for yourself and pay less tax? There's an option there. And finally, time the sale of those assets so that they're taxed in a different tax year. So definitely having some advice around timing of selling things can make a huge difference to the amount of tax that you're paying, especially when we're talking about property and shares. If you've made huge capital gains, then they can impact on your income. So having those conversations with your accountant early rather than when you're doing your tax return can make a huge difference to how much tax you're paying overall, and what strategies you can do to reduce using other deductions to minimize your tax overall. So, little quick word about tax planning. We recommend you work out with your accountant to plan out your taxes schedule, hold some aside if you've got tax installments, work out if your investment is working for you, work out how salary packaging might impact on your tax take-home pay, how you can set up a business, how you can plan for tax. So all of these things are things that we help you with at Northwest Accountancy with regards to tax planning. You don't just have to see us once a year to do your tax return. So, any questions? Not at this stage, but that's okay. If you do, then that's absolutely fine. So, another little QR code. If you've got enough information that you know that doing your own tax is a little bit scary, then we are absolutely able to help get this done for you. So feel free to jump to that website, northwestaccountancy.com.au/tax, or click on the QR code, it'll take you there. Joseph, did you have a question or a comment?
Oh, silly one. But yeah, so if I use my internet to log in from home to be able to work at the office
Mm-hmm.
and I can claim that as a deduction,
Mm-hmm.
why can't I claim the deduction to drive from home to the office?
Good question. Tax office says no.
I
Um,
know, I know it isn't, but those are the things that people ask you, and it
absolutely.
isn't.
Yeah.
I can actually find understand why they ask it,
Yeah.
but unfortunately, indeed, it is a no. But yeah,
Yeah. Yeah. So the correct answer, not just tax office says no, is because when you log on to work through your internet, it is expected that you are working. Whereas the point of traveling to work, you don't actually get paid to travel to work. You get paid from the time you show up to work. So there's no actual link between driving to work and getting paid. So if they paid you from 7 o'clock and you hopped in your car at 7 o'clock and then you drove to work, then absolutely you could claim that. But generally, you don't get paid to drive to work. And so there's no link between the cost of driving to work and getting your income.
unless you go to a different office.
That's right. In each
And you
case,
don't
it
get
is
paid for that
claimable.
normally either for the travel. But
Yeah.
yeah, no, you are
Yeah.
a really good presentation. Thank you so much.
Pleasure. So a couple of final pieces, connection points. So you can find us on Facebook, my personal brand, Jodie Porteous Money Management Coach, Northwest Accountancy, Facebook, website, YouTube, all of the places. And thank you so much. If you do have any questions, feel free to email me or connect through onto any of the socials, and I'd be happy to point you to the right place for any advice or book in for a conversation. So, yeah, thank you so much for your time tonight. And yeah, if you've got any questions, please reach out. Otherwise, timely taxes. Get them done quickly, accurately, and on time.